In this video, we're uncovering why one of the most closely watched portfolios in America just placed millions of dollars on two very different technology stocks, and why those moves could reveal where some of the biggest opportunities in the market may still be hiding. One of these companies sits at the center of a massive shift in artificial intelligence and domestic manufacturing. The other is a beaten-down giant that many investors may have given up on too soon. And the person making these bets is someone whose stock trades have attracted attention for years because of how often they seem to be ahead of major trends. Few congressional portfolios attract as much scrutiny as Nancy Pelosi's. Whether you agree with politicians trading stocks or not, investors pay attention whenever a Pelosi filing hits the market, and for one simple reason: the track record has been hard to ignore. Her husband, Paul Pelosi, who executes the family's trades, has previously disclosed positions that significantly outperformed the broader market. Some of those investments generated extraordinary gains while many investors were still trying to figure out where the next winners would come from. Now he is making another big move. According to recent filings, Pelosi purchased call options on two technology companies on May 29, 2026, with a combined disclosed value of as much as $6 million. And these were not small speculative bets. These were large, high-conviction positions. The filing itself is fascinating because both positions are structured almost identically. When investors with decades of experience choose this type of structure, it often signals one thing: conviction, and the first company on that list may be one of the most surprising stories in the entire stock market this year. Intel, ticker symbol INTC. For years, Intel was considered an aging technology giant, a company that had lost its edge, a former industry leader struggling to keep up with changing technology. Many investors wrote it off, many analysts moved on, and then something remarkable happened. Intel came roaring back. The stock has skyrocketed more than 260% this year alone. Over the last 12 months, shares have surged roughly 500%. Think about that for a moment. 500%. That kind of move does not happen because of hype. It happens because investors suddenly believe a company's future is dramatically different from its past. So what changed? The answer begins with something much bigger than one company: artificial intelligence. Every major technological revolution creates new winners. And every revolution requires infrastructure. Just like the internet needed servers and smartphones needed semiconductors, artificial intelligence needs enormous computing power. It needs advanced chips. And suddenly Intel finds itself sitting in a very interesting position. The company delivered a first-quarter earnings blowout that completely changed investor sentiment. Strong execution, improving demand, and a growing list of strategic partnerships created a perfect storm for the stock. Then came another catalyst: a manufacturing deal with Apple. And then another. Elon Musk's Austin Terafab selected Intel's advanced chips. One positive development turned into several, one catalyst became many, and Wall Street began rethinking everything it thought it knew about Intel. But perhaps the most important part of the story has nothing to do with earnings. It has to do with national strategy. The United States government currently holds approximately a 10% stake in Intel. At a time when domestic chip manufacturing has become a matter of economic and national security, Intel suddenly enjoys something that few companies can claim: policy support. The push to bring advanced manufacturing back to the United States has created a powerful tailwind. Governments around the world increasingly recognize that semiconductors are not simply products. They are strategic assets. They are essential infrastructure. The countries that control advanced chip manufacturing will have enormous economic advantages over the coming decades. And Intel sits directly in the middle of that trend. This may explain why analysts have become increasingly bullish. Bank of America double upgraded Intel from underperform to buy earlier this month. Not one upgrade, a double upgrade. Then they raised their price target from $135 to $160. Their reasoning was straightforward. The server CPU market could exceed $2.7 trillion by 2030. $2.7 trillion. That is an astonishing figure. When investors talk about artificial intelligence, most focus on the companies creating the software, but none of that software exists without the underlying computing infrastructure. And that infrastructure market may become one of the biggest opportunities of this decade. Now let's look at Pelosi's actual trade. 200 call contracts, $50 strike, disclosed value of $1 million to $5 million, expiring March 19, 2027. At the time of disclosure, Intel was trading around $134 per share. That means the contracts already contained approximately $84 of intrinsic value per share. In simple terms, the position was already deeply in the money. This was not a lottery ticket. This was not a reckless gamble. This was a high-conviction position in a company that had already proven itself to be a winner. And that raises a very important question: why make this trade now after such an enormous rally? The answer may be surprisingly simple, because the story may only be getting started. The biggest investment opportunities often look expensive. Think back to some of the greatest stock winners in history. Many appeared expensive after doubling. Then they doubled again, then doubled again. Markets tend to underestimate the duration of powerful trends. And artificial intelligence may be one of the most powerful trends we have ever seen. Intel's management has been very clear about one issue. Demand is not the problem, supply is. That is an extraordinary statement. Companies rarely complain about having too much demand. When demand exceeds supply, it often means customers are willing to wait because they believe the product is essential. For Intel, two milestones could determine the next phase of growth. The first is the successful ramp of its 18A manufacturing node. The second is the execution of its Apple production schedule. If both go according to plan, investors may continue assigning a higher valuation to the business. And there is another reason this story matters: scale. Building advanced chip manufacturing facilities requires enormous capital. The barriers to entry are massive. You cannot simply decide to become a semiconductor manufacturing leader tomorrow. The expertise, talent, infrastructure, and investment required are staggering. This creates a powerful competitive moat. When a company operates in an industry with extremely high barriers to entry and enjoys government support, investors pay attention. Apparently, Nancy Pelosi's portfolio is paying attention too. The market often rewards companies that become strategically important, and Intel is increasingly looking like one of those companies. Now, could the stock pull back? Of course. No stock moves straight up forever. Volatility is part of investing, but the question long-term investors ask is much simpler. Will this business matter more 5 years from now than it does today? If artificial intelligence continues expanding, if advanced manufacturing remains a national priority, and if demand for computing power keeps growing, there is a strong argument that Intel's relevance could become even greater. That possibility may explain why millions of dollars are now riding on this trade. The options do not expire for another 9 months. This is not a short-term bet. It is a position bet. A bet that Intel remains comfortably above $50. A bet that demand stays strong. A bet that manufacturing execution continues improving. And perhaps most importantly, a bet that the artificial intelligence revolution is still in its early innings. The stock market often creates opportunities by forcing investors to choose between what has happened and what could happen next. Many investors see a stock that has already risen 500% and assume the opportunity is over. Others see a company that has fundamentally changed and believe the next chapter may be even bigger. Nancy Pelosi's trade appears to fall into the second camp, and history shows that when structural trends collide with improving execution and supportive policy, extraordinary outcomes can sometimes follow. The next few quarters will be critical. Investors should watch Intel's earnings reports closely. Pay attention to manufacturing updates. Watch for signs that supply constraints are easing. Monitor customer demand. Because if the company continues delivering on its promises, this remarkable comeback story may still have more room to run. And that may be exactly what this multi-million-dollar options bet is really saying. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move to the second stock, because this one tells a completely different story. While Intel represents a company that is already winning, this next investment looks like a bet on a comeback, and sometimes those can become the most rewarding investments of all. The second company in Nancy Pelosi's latest filing is Uber Technologies, ticker symbol UBER. This trade stands in sharp contrast to the Intel position. Intel has been one of the market's biggest winners. Uber has been one of its disappointments. The stock is down roughly 10% this year and has fallen about 19% over the last 12 months. At first glance, that might make investors wonder why anyone would want to buy it. After all, if a stock keeps falling while the broader market rises, doesn't that usually mean something is wrong? Not necessarily. Sometimes the stock market and the business itself are telling two completely different stories, and Uber may be one of the best examples of that disconnect. The company that changed transportation around the world has quietly transformed itself into a much stronger business than it was just a few years ago. Many investors still think of Uber as an unprofitable growth company that burns cash and depends entirely on ride-sharing. That version of Uber no longer exists. Today's Uber is a highly diversified platform business with powerful network effects, expanding profit margins, and one of the largest consumer ecosystems in the world. The company's moat comes from something that is incredibly difficult to replicate: scale, millions of riders, millions of drivers, massive amounts of data, global brand recognition, and a platform that becomes more valuable as more users join. This is what investors call a network effect. The more people use the platform, the stronger the business becomes. That creates a powerful competitive advantage because building a rival network at the same scale would require enormous amounts of time and capital. But the most interesting part of Uber's story today is not transportation, it is engagement. In the first quarter of 2026, Uber delivered an earnings blowout. Earnings per share surged 44% year over year to 72 cents. That is not the type of growth investors expect from a mature technology company. That is the kind of growth that gets Wall Street's attention. Even more impressive is what happened with its membership business. Uber One now has more than 50 million members. 50 million. Think about the significance of that number. Membership programs create habit. They increase customer loyalty. They encourage people to stay inside an ecosystem, and they often lead to higher spending over time. Some of the most valuable businesses in the world have built powerful subscription ecosystems because recurring customers tend to be incredibly valuable. Every new Uber One member increases the stickiness of the platform. It makes customers less likely to leave, it improves retention, and it creates additional opportunities for future growth. But perhaps the most important part of the Uber investment case is what analysts expect over the next several years. Wall Street projects that Uber's annual earnings could more than double from approximately $3.30 per share in 2026 to nearly $6.87 per share by 2030. That is a dramatic increase in profitability. If those estimates prove even close to accurate, investors may eventually have to rethink how they value the company. And Nancy Pelosi may be looking at exactly that possibility, because when you examine the details of her trade, something interesting appears. Just like the Intel position, the Uber trade consists of 200 call contracts with a strike price of $50 and an expiration date of March 19, 2027. At the time of disclosure, Uber was trading around $74 per share. That means the options already had approximately $24 of intrinsic value per share. Again, this was not a speculative lottery ticket, it was another high-conviction position. A bet that Uber remains comfortably above $50. A bet that the market is underestimating the company's future, and perhaps a bet that investors are focusing too much on the stock's recent weakness and not enough on the business itself. There is another reason this trade deserves attention. One of Wall Street's most respected investors also believes in Uber's future. Bill Ackman's Pershing Square Capital Management holds Uber as one of its largest positions. When experienced investors independently arrive at similar conclusions, people notice. Of course, no investor is right all the time, but when multiple sophisticated investors are willing to commit serious capital to the same company, it often signals that there may be something the broader market is missing. And in Uber's case, that something could be the next phase of its growth story. The company has made it clear that autonomous vehicles represent one of its biggest long-term opportunities. For years, investors feared autonomous driving would eventually destroy Uber's business model. Now the company is trying to turn that threat into an opportunity. Instead of building every technology itself, Uber has positioned its platform as a distribution network. More than 30 autonomous vehicle operators are already on the platform. That is an incredibly important development. Because if autonomous transportation becomes mainstream, the companies that connect riders with those vehicles could occupy an extremely valuable position in the ecosystem. Uber already has the customers, it already has the app, it already has the global infrastructure. The company simply needs to continue integrating new technologies into its platform. The next key test will be whether those partnerships start translating into measurable bookings growth. If autonomous initiatives begin driving meaningful revenue expansion, investor sentiment toward the stock could change very quickly. Markets often reprice businesses long before the full financial benefits appear. That possibility may be one reason Pelosi's options extend into March of next year. 9 months can be a long time in the stock market. A lot can happen. A company can execute. A new growth driver can emerge. Investor sentiment can shift dramatically, and beaten-down stocks can suddenly become market leaders. This brings us to one of the most fascinating aspects of the Pelosi portfolio: the strategy behind these two investments. Intel and Uber could not be more different. One stock is already a huge winner. The other is struggling. One investment is betting that momentum continues. The other is betting that a recovery eventually arrives. Yet both trades use the exact same structure. The same strike price, the same expiration date, the same bullish approach. In plain English, the portfolio is trying to win in two different ways. Continue backing a stock that is already succeeding, and accumulate a company that appears undervalued. That kind of diversification in thinking is something every investor can learn from. Markets are constantly creating opportunities in different places. Some opportunities come from strength, others come from pessimism. Successful investors often know how to identify both. The Pelosi filings do not tell anyone what they should buy. They are not investment recommendations. But they do offer a fascinating glimpse into where sophisticated investors are placing serious capital. And in this case, the message seems clear. Artificial intelligence remains a major theme, domestic manufacturing remains a major theme, and platform businesses with improving profitability and long-term optionality remain highly attractive. The next several quarters will reveal whether these bets pay off. For Intel, investors should closely watch manufacturing progress and demand trends. For Uber, the focus should remain on profitability, membership growth, and autonomous vehicle partnerships. If both companies continue executing, these options may end up looking incredibly well-timed. But even if one position struggles, the strategy itself offers an important lesson. Long-term investing is not about finding certainty. It is about identifying probabilities. It is about finding businesses with durable advantages and giving those investments enough time to work. That appears to be exactly what this portfolio is doing. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. As investors, it is easy to become distracted by headlines and daily stock price movements. But the biggest returns often come from understanding where businesses may be heading years from now. Intel and Uber represent two very different paths to potential wealth creation. One company is riding an enormous wave of artificial intelligence and domestic manufacturing investment. The other is quietly building one of the world's most powerful consumer platforms while positioning itself for the future of transportation. Both have risks, both face challenges, but both also possess qualities that experienced investors clearly find attractive. And that is why these trades have captured so much attention. Because when millions of dollars are committed to companies sitting at opposite ends of the performance spectrum, investors naturally ask a simple question. What are these buyers seeing that others may not? That question alone makes these two stocks worth watching very closely over the coming months. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which company do you believe has the stronger long-term advantage? Intel with its position in artificial intelligence and domestic chip manufacturing, or Uber with its global platform and autonomous vehicle ambitions? Let us know in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.